Welcome to the Invested Teacher Podcast with Cal Pierce, Matt Bigley, and John Orr.
Get ready to be taught as we share our successes and failures encountered during our real-life lessons, learning how to build generational wealth from the ground up.
Welcome, invested students, to another episode of the Invested Teacher Podcast.
Awesome stuff, guys. Let's dive in here. We're excited to bring you another episode of the Invested Teacher Podcast, and we've been on a roll here. We've been talking a lot about hurdles on getting into your first investment property, or maybe it's your second or third, but something that's been holding you back. In a few episodes ago, we talked about this analysis paralysis of always trying to think about all the ins and outs of getting into a deal so that you can build your wealth. But if we don't, take that first step, it might not all be for anything. So we want to think about what are some of the hurdles that are preventing us from taking that first step, and we want to alleviate or give you some insight on how to think about these hurdles so that you can take your first step just like we have taken our first step. And in this particular episode, we are going to go all in on looking at the technicals when analyzing a deal. So we're going to look at the numbers and decide what numbers help us make this deal, and what numbers actually can we look at so that that we can be like, you know what, that deal is no good just based on the numbers. Yep. And we walk away. It saves us some time. But we also want to see, hey, this deal is worth pursuing. This deal is worth actually going and looking at some more fundamentals. So before we get into that, Kyle, fill us in on what we talked about last time.
Yeah, absolutely. So you did a great job sort of getting us set for this episode. Last time, we were digging into more of the fundamentals. This is like Matt's sort of bread and butter, looking at the neighborhoods, looking at, the tenant profile, looking at different types of properties. And we even discussed a little bit about this idea that a property that might be right for one investor may not be right for another, and vice versa. So this is something like we, early in our career, as we mentioned, or early in our journey, I think we sort of looked at things only from our own perspective, and we're sort of trying to find sort of rules, like a rule of thumb that will work for anybody. And the reality is that rule actually doesn't exist. So you have to look at the fundamentals and decide, what kind of investor are you? Like, what kind of investor do you want to be? Because the end all be all isn't the actual number. It's not about this percentage being higher than that percentage in terms of a return. It really comes down to what's going to fit for you. So we looked at the neighborhood, as I mentioned. We looked at how to decide if that property is right for you, and some of the things that you might want to be looking for in rental properties. Now, when we flip to today, we're going to dig into more of the technical side. This is the side that I tend to enjoy jumping into first, as we said last time. Matt sort of comes from more of a fundamental standpoint. If you have a team that you're going to be investing with, that's always a great option. Like, to have both sides sort of working for you is amazing. Or maybe that's why you want to look at a joint venture opportunity where maybe you bring something to the table, maybe you bring that technical side and the other person is more of the fundamental side, or vice versa. So just some things for us to think about. So let's start our conversation around some of the technicals. Matt, lead us in here. Like, what are we going to be talking about today? What is the technicals? Like, what is this all about?
Yeah, and I love that we can have an entry point to examining a property from either this fundamental perspective or this technical perspective, but no analysis is complete without looking at both sides of this. And listen, I am not a numbers guy. I'm not a math guy. I was a history major, guidance counselor. So it's really great to be partnered with two number crunchers. But I really want to stress for everyone out there, you do not need to be any kind of numbers wizard to be able to understand this stuff. It's really about the magic of first asking the right questions, and then having a spreadsheet or a resource that you can plug all the stuff into. And we'll emphasize, as we have in previous episodes, this is really a numbers-based game. This is not, about an emotional decision because your family isn't going to live there. So this is really about developing a system that can just become a habit when you look at properties. So first and foremost, I want to stress that you don't have to be a math person. You don't have to be magic with numbers. You just need to know the right questions to ask so you can get the numbers you need, because, little insider tip, real estate ads don't always tell you everything you need to know. And
tricky.
Remember that listing agent is working for their seller. Sometimes they may even omit information that is going to be integral to you actually analyzing this property. So I think knowing what we need to look for first, getting those answers, and then having a tool to plug these answers into in order to do our analysis is key.
Awesome. I want to dive into that. And I know that in past episodes we've talked about, benefits of investing in real estate. We talked about the three silver bullets of investing in real estate. One being, getting your cash flow, another one having appreciation where the house value goes up, and another one paying down the mortgage, so building that equity automatically from the renter. So we talked about those three areas of the benefit here, and I think that's where the technicals help you make this decision, is like, what is going to be like, can I think about my appreciation? Can I think about and calculate what the cash flow is going to be on this property? We want to know that number so that we can help make a decision. We also want to know, like, if this goes through, can we pay this mortgage down with the renters? We want to make sure all the numbers work here. So let's dive in here. Kyle, I know that we've got a spreadsheet that we've been using to help analyze properties. We want to share that with you. So we're going to walk through a sample, like an example of a property, and go through the numbers here. We're going to talk through those numbers with the spreadsheet. And you can also follow along if you like. You can go over to investedteacher.com/analyze. That's investedteacher.com/analyze. Pull up this spreadsheet, follow along with us. So if you're on a computer, and you're, you've got video, you could jump on over to the YouTube version. We're going to pull this up on our screen so that you can see it. But if you're only audio and you want to jump right into the spreadsheet and kind of follow along and play with it as we describe it, head on over to that link I just described and pull that spreadsheet up so you can see what are the items that we are going to look at for numbers, and how do we calculate some of these really important numbers to help you take all the emotion out of making this decision for us. So Kyle, let's jump into that spreadsheet. Walk us through what is the first thing, Kyle, you do when you pull your spreadsheet up? Like, so for example, we've already thought this is a deal. I want to do an analyze on it. It meets the criteria for, what I'm looking for. Maybe it's a single family home and that's where I want to go. Maybe it's a multi-family home. And I'm like, yeah, I think the numbers might work here. Mm-hmm. Is there any tips, resources that you can do right away, Kyle? Like even like, is there something you look for in the numbers before we even get to the spreadsheet? I'm curious. There's like, I'm looking there. I don't even have to go to the spreadsheet. I know that deal's not going to work. Or do we put everything in the spreadsheet?
Yeah, no, totally. This is great questions. And I should mention too, the spreadsheet we're sharing with you is definitely a pared down version of the one that we've sort of crafted over time. Like what you're going to find is what you should do is start simple. And then over time, you're going to have certain things that you're going to want to add in and just, let it mutate, let it sort of transform over time into something that works for you. So actually, interestingly enough, all three of us have different sort of analyzer spreadsheets that we use because of our, personalities, how we like to set things up and so forth. So that's just a disclaimer. So this one you're going to see, we've tried to keep it as clear and concise as possible. If you look at mine, like when I share mine with these two gentlemen, you guys are like, what are you doing over here? So you're going to get your own.
I don't even want to look at it.
Yeah, exactly. It gets a little scary. Now, that doesn't mean like that yours has to be that way for this to be effective. What it just means is that you want to know what you're doing. And to be honest, when we started putting this one together, all three of us had to do a lot of homework to really understand how it worked, to ensure it worked in the way we thought it did. So I would also reference that. So we'll go through that with you here today. But to your point there, John, or to your question, you were asking, like, are there any rules of thumb? You'll hear rules of thumb on different podcasts, especially on US podcasts, about this 1% rule. And the 1% rule is all about the rent, the monthly rent. If it's 1% of the cost of the building, or the property, I should say, then usually that means it's like potentially a good deal. We say potentially, no guarantees, right? So anything above that, you're sort of like, woohoo! And anything below that, you're like, I don't know. But the reality is, especially if you're listening from here in Canada, is that the 1% rule sort of went out the window a long time ago. So you'd have to be more... I guess it's like there's less opportunity for those low-hanging fruit. In the U.S., there are still some of those opportunities, but again, each market varies, and we had mentioned on a previous episode that there's like different neighborhood dynamics, I'm going to argue, or at least more drastic neighborhood dynamics than you may find in certain communities here in Ontario or Canada, depending on where you are. So that 1% rule is helpful. Like if it's like way below 1%, then it would definitely suggest that it might be difficult to start cash flowing. So like usually what I look at very quickly is that's my starting point. It's almost like in math class, John and I call these benchmark. It's like our benchmark number. And then you're just kind of working within that. So if I look at a building and I go, okay, the purchase price and what we have on the screen here is $2,000. Or $200,000.
Yeah,
I'll take it. I'll take it.
Yeah,
we're in.
Yeah, exactly. We're at like 100%, rent to price ratio. No, so at $200,000, if I see that the rent is $1,000, right there, I'm going, ooh, that is like 0.5%, right? $2,000 would be 1%. So if it's near that 2,000 mark, I'm like going to be curious. If it's well above 2,000, then I'm going to be like super curious, but I'm going to be also maybe cautious if in the market that's an unusual thing, right?
It's not a hard and fast rule here, like you said, Kyle. It's just a gauge to go, hey, I could rule this out, or I might want to investigate a little further. Kyle, in the idea of the 1% rule, is that the rent generally, with thinking about all the other numbers we're going to talk about here, land transfer tax and the mortgage and property tax and electricity and gas. Is the 1% rule created or was created because it generally that the rent should cover all of those things and then still leave you with some value here?
Yeah, that's actually a great question. So you name some of the things that are upfront costs, and typically the 1% rule isn't really to help us with those upfront costs. That's just part of getting into this investment. And, I heard this once, and I wish I could cite it appropriately, but somebody was saying it's like starting any business where you're starting a business here. So there's going to be some upfront costs. That would be your down payment, your land transfer tax, your inspection, your appraisal, closing costs. Any of those pieces, they're going to get lumped into sort of your upfront cost out of pocket. The 1% rule is something that's going to help us try to gauge, like, is this thing going to cash flow or not? And then another thing that I think is really important for us to consider as well is that as you get to know the market that you're going to be investing in, and Matt would know this being a realtor here in Windsor, Essex, what Matt would be able to do, or what we would be able to do having been investing here, is when we see that rents are significantly low, there could still be an opportunity there. Maybe rents are actually lower than market rents, and therefore that ratio may not be as helpful to us now. What it tells us is that maybe there's an opportunity for us to up those rents over time, and it might be more of a longer value add play. So we are looking at that 1% rule as a means to try to stay cash flow positive. Okay. So once again, it's like we assume that we're going to have a down payment and a mortgage. But again, if you're someone who has a lot of capital sitting on the sidelines and you're like, I want to be in real estate and I don't necessarily want to leverage myself with a mortgage, like, the 1% rule is probably like not an issue for you because you're going to remove that mortgage cost completely from your bottom line. So again, everything depends on your particular scenario. But if you're assuming that you're going to carry a mortgage and all of those monthly costs like, insurance, property taxes, any like repairs and maintenance, which you want to budget in, because the reality is the building is over time, it is going to require fixing. And it might be a lot of fixing up front, like Matt and I experienced with most of our early properties. We prepared for that. So we made our spreadsheet like almost like way conservative because we were like, we want to make sure that we account for all of these old things, all these capitalization costs or capital costs that we're going to have to actually put into the property. But we adjusted for that in our spreadsheet. So every property, every neighborhood, every situation is going to really depend. But that 1% rule gives you at least like a target. It's like a starting point to kind of give you something to work from and work around.
Gotcha. Thanks for filling us in on the 1% rule, because I know that's been floating out there. But I like the fact that you put a caveat there and thought like sometimes the 1% rule in the past has been very helpful, but a lot of times if it doesn't necessarily have to make or break this deal. We could look at something lower than a 1% deal. It still can make a lot of sense. So that's great, and I think you've given us some value there to think about, and something to check right away. If we get into the spreadsheet a little bit, I'm curious about some of the initial items that we should think about, right? Like, the purchase price of the property. We know that when you buy a home, that process is the same. Working with a realtor, you're going to try to negotiate there for that purchase price. But Matt, what are some of the other things that we should budget into this spreadsheet? Like thinking about, we want the spreadsheet to actually accurately represent all of the numbers that we're going to spend and also bring in. So thinking about, like Kyle said, as a business, we have like all of our expenses, and then we also have all of our income, and we want to make sure that the income outweighs the expenses if this is going to be the right deal for us, and we want to look at those numbers for sure. But if we think about some of these upfront costs, what should we be thinking about when kind of analyzing the upfront costs here, Matt?
Yeah, I think what I love about the spreadsheet is that you can really play with the purchase price. So when you're analyzing properties, you can assume worst case scenario. So if you were paying full up for this property versus if you were to get it, for various increments. So it really allows you to easily and quickly move those numbers around to see. And the way the spreadsheet's been set up is that land transfer tax is going to adjust accordingly. We've got things like inspection in there as a fixed cost, but this is really going to help you be able to analyze things really, really quickly. So I think, when we come back to looking at questions we might want to verify through a listing agent, we want to definitely, if the property is currently tenanted, we want to know, what the current rents are. And this goes back to the fundamentals episode we have. We want to make sure that those properties are optimally having separate meters so that those tenants are paying their own utilities. So we want to verify some of those fundamental questions first of all, because again, paying utilities means you're going to have to either charge a higher rent, which is harder to get tenants for, or it's going to just cut right into your profit. So we want to know what are our current rents? When were rents increased the last time? You'll find this with a lot of landlords who've owned properties for a lengthy period of time. They haven't increased rents. Now, I should say, you can legally increase rents annually, but the percentage is dictated by the government, and typically it's very small, like under 2%. However, I just recently had a property where they'd had a tenant in there for over 20 years. So obviously the cumulative effect of those 2% or thereabouts increases would have at least helped to make this property more attractive to a prospective buyer. But we do find a lot of longtime landlords just haven't necessarily done this. So we want to know when were rents increased last. And we also then want to do a check to see what market rents might be. And rents are so fluid right now. Currently the vacancy rates are so incredibly low. So I typically go to Facebook Marketplace and I look in that same neighborhood to see what are market rents. So, and the other one is Zumper, like jumper with a Z. Those are two sources of, because we'll find more and more rental units are being advertised on MLS or on Realtor.ca. But I actually find Facebook Marketplace to be kind of the most update place to typically go for that sort of stuff, because we want to know if there is a gap between current rents and projected rents. That's a whole other conversation about how to achieve that when you've got a tenanted property, but we want to at least understand what the potential might be for that. We want to verify taxes for sure, because sometimes those tax numbers are outdated or old. But going back to those fundamentals, we want to understand, what major updates have been done to the property, because we should talk about things to make sure we include in our analysis, like repairs and maintenance. Some analysis done by the listing agents, they don't include a category for repairs and maintenance. Well, we know from owning properties and buying properties early on that we're in rough shape. Man, some of these properties we're investing thousands or tens of thousands of dollars in a year when we've got to do a major turnover if it has never been turned over before. And then vacancy rate as well. We always include a number for vacancy rate, even if it's a fully tenanted property, because again, we try to be as conservative as possible when we do this analysis. And then we can back some of these numbers out if needed. And the other one to include in your analysis that the listing agent probably isn't accounting for would be property management. So we started in this by managing our own properties. And after about 4.5, 5 years, we decided to take on active property management. And so there's a fee for that. There's a trade-off for that. Certainly made it a lot more passive for us, but we want to include that in our calculations as well. Now, a lot of people may decide to manage on their own. That's probably a future episode to talk about, self-management versus having a property management in place. But we want to make sure we account for all of those things in our calculations and our spreadsheet. And whether the current owner is doing those things or not, we want to make sure that we err to the conservative side, to the safe side when we do that.
I love it. I love it, Matt. And you brought up so many things. I want to go back. I'll start from the end here with the management. And, I would say like one of the best things you could do is actually self-manage at first to understand what's happening. Because if you have a management company come in, the reality is over time, and John and I have this through our online business as well, that we have contractors that work for us and with us in the company. It's like if we don't know what the day-to-day is of the business, we don't know where to direct them, and we don't know how to help manage them. So ultimately, when you have a management company, you're essentially managing the manager, which is better than having to manage tenants. Trust me on that. But it's still not completely passive. So what you need to do, what the messaging I'm hearing Matt say is you need to adjust for your own situation. Now, up front, if you know that you're going to self-manage, you could put your management fee to 0%. But then what happens if you get through 3 months of managing and you realize you're like, this is way too much for me? You're either out of the deal, or now you got to bring on a management company and you haven't accounted for it, right? So maybe accounting for it is worthwhile. And if you like managing, then it's just extra on your bottom line, right? Like you've been conservative in your numbers so that you feel good about it. Going up to vacancy and repairs and maintenance, we now use 5% for each. So 5% for repairs and vacancy, repairs and maintenance, 5%. Vacancy 5%, but way back with our first big purchase, Matt and I, and Matt, you'll remember this, ultra conservative Kyle over here, I used to use 10% for each because I was trying to pad all of the expenses as much as possible so that we would be pleasantly surprised versus really disappointed if it didn't come in on point. So that was something we did early on. We've now adjusted down based on what we know about the properties and how our business works. Capital expenditures as well is something that you can adjust depending on, maybe you want to use Dan Crosby's 0.1% rule we discussed on last episode, depending on how old the building is. And, that's going to change the potential capital expenditures. Or maybe based on the inspection, you can see that the furnace is going to go, the this is going to go, the that's going to go, and you want to pad those in there. So being conservative with these numbers is massively important. Now, I want to go back as well to the whole idea.
Go ahead. We're talking about that, guys, let's clear up a couple things here. We're talking about our monthly operating expenses. And when you guys are referencing, let's just make this clear for anyone new listening and thinking about getting into this, and you remember this was a hurdle for a lot of people, is when you're saying 5%, 10%, 7.5%, for example, on our spreadsheet here, we're recommending that, what you guys are currently using is a vacancy of 5%, which means, and correct me if I'm wrong here, guys, you're saying that you're budgeting 5% of the rent, right, to go towards a vacancy fund where you're like, I'm going to put 5% of the rent accumulated in this fund, and then that will help pay for the vacancy when it occurs. And you're saying 5%, because we're throwing numbers out here, but we haven't said what 5% of this. Like, it's not 5% of the purchase price, it's 5% of the rent. Is that correct?
Absolutely. That's a great clarifying question. These percentages are based on your monthly operating expenses, so based on your actual income coming in each month, and that's what's going to sort of populate here. Your 1% rule up here is based on your monthly rent comparative to the purchase price. So each of the percentages in the sheet, just be cautious to think it through. But that is a great clarifying question. The other piece that I wanted to also go back to around what Matt was describing around rents. When you're looking at market rents, something that is more, I would say more typical is that rents are lower than market rents, which is actually, while upfront isn't helpful, it shows potential for the future. So you might use a more closer to market rent number to help you make your decision as to whether this is a worthwhile property. The one caution I would have is if you see that the rents are great, and maybe they are, like maybe there are tenants in there and the rents are great, but the rents are actually at the top end of market rent, you have to start wondering how helpful or how good that is. It looks good on your bottom line, but are those tenants, first of all, prepared to pay that rent? Second of all, are they going to look around and say, there's other properties that I can get for a lower rent that are comparable? So for us, we tend to try to be somewhere in the middle of the market rent, like closer to the average rather than on the top end. So for example, my Arizona property, tenants have given us well in advance. They've given us 90 days just because they're kind. We've looked at market rents. Market rents are at $1,700. Right now, the current tenants are paying about $1,250. So there's an amazing bump there. I would much rather get 16 than say 17 and potentially have less tenant selection and maybe like less motivation for them to want to stay and so forth. So those are all key pieces. So great numbers are awesome, but only if it's reality and only if it means that it's going to make your life better, having done that.
Is there, guys, before what I would think is really helpful for, especially for our listeners here, is if we actually walk through each portion of our sheet, say the numbers out loud so our listeners can get a sense of, where our total cash investment is going to come from, what in this particular example, what the rent and income is, what are the expenses, and then we'll get into how to look at that in terms of your monthly cash flow, your annual cash flow, and then your year one appreciation and value adds and return on investment. So is there anything else you guys want to outline as a high level piece of this before we jump into looking at the actual example and walking through piece by piece so that people listening go oh, okay, I can calculate that. That makes sense. And then by the end we have a number and we go, and this number we use in this way. Is there anything else you want a high level here?
My only wonder, guys, is we've sort of, zeroed in on this 1% rule, which we have, admittedly is a little bit out of date in this current market. Do we want to talk about some of the other big look fors and what they mean and what they look like before we get into our example?
Of course. Tell me where you're thinking. I've got a couple ideas, but I feel I see the wheels
what are the
turning
other?
over there,
I mean,
Matt.
just what are the other big ones that we used to look at a lot, and certainly again we've had to be really fluid with this as the market has changed. Was cap rate or capitalization rate, and I think it's an interesting conversation to understand what a cap rate is, how it's calculated, what to look for. But the one that's probably most understandable to our invested listeners is, what is your ROI? What is your return on investment? So what is your return on the actual cash amount you're putting in? Kyle, can you talk us through cap rate and cash on cash ROI?
I love it. Cap rate's actually a really interesting one because capitalization rate, if you really think about it, it's comparing how, and I'm going to show you in the spreadsheet here, it's how much you anticipate you're going to earn in 1 year. And you're essentially dividing that by how much you've actually put into the deal. So over here, if I look at my purchase price is $200,000, and I look at this and I go, okay, so on this, I can expect a cap rate, an annual cap rate of 3% based on the numbers we're throwing around. Now, notice our monthly cash flow is actually negative after we were adjusting some numbers here and playing around. So right here, the cap rate looks low. So what you're hoping for is a higher cap rate, of course, but we personally never look at the cap rate as sort of like the end all be all. And we also don't look at the actual return on investment as the end all be all. One of the big pieces we look at is cash flow as sort of our main goal. Now, when we look at this particular property, I adjusted the rents down. We had a purchase price of $200,000. And our actual rent we put in right now, we adjusted and put $1,500. So you could see it's under the 1% rule. And based on The expenses that we now have, given the numbers that we've thrown in here, all of a sudden now we have a negative cash flow. So this property, even though with a 3% appreciation and some mortgage pay down, it's still showing your return would be about 12%. But our cash on cash return would actually be negative, meaning the money we put in upfront, that cash is actually not growing. It's actually going away. Like we're losing money because I got to put money into this property. Now, you might be someone, like I said, who has a lot of cash on the sidelines, and you're looking at that and you're like, you feel safe doing this and it's in a nicer neighborhood and therefore it isn't cash flowing. But I'll be honest and say that maybe there's better options for you out there. Like for us, this deal wouldn't be something we'd think about. Or if we really like the neighborhood, we really like the building, and we love the potential, this is where creative thinking has to come in. So we have to go, well, okay, well, what else needs to change? Is it worth it for us to put a bigger down payment in so that the mortgage amount comes down? Is it worth it that we try to do a vendor take back? And I look at this and I go, well, hang on a second. Our interest rate right now, and we're recording this February 21st, 2023. So like getting, financing is going to be around 6%. And again, I would rather be more, on the upside. Maybe some of you want to bump that up even more, depending on your credit score, your history with different lenders. If you don't have lending history, then that might be a problem, and that might cause a higher interest rate. But if we really like this property, we might go back to the seller and say, hey, listen, you don't have a mortgage on this property. What are you planning on doing with the funds? Do you need the funds for something immediate, or are you just going to put it into a safe and completely passive investment like a GIC here in Canada, or treasury bills in the US, or something super, super conservative? Maybe we can work something out where, we give you a down payment and we work out a more favorable interest rate for us, and then you have the property as the backing. So there's like some upside benefit to them. If we default, they can actually take the property back. And that's what we did on our previous purchase with Gordon, is like the cash flow numbers as is wouldn't work, but we liked the building, we saw the potential, and that's where we get super creative. But right now, these numbers aren't going to be working for us. So again, there's no rule of thumb of like minimum returns on investment. For us, number one, we look at cash flow. We try to be conservative with our numbers. So we try to be more aggressive on expenses, meaning the expenses are higher, which may mean that our cash flow is going to appear lower. And again, we'd rather have the pleasant surprise than, being disappointed. So that number might be lower, but it's like if we can keep it positive, and we're assuming, let's say, a 3% appreciation, you might, think in your market, hey, listen, the next couple of years, I think it's going to only be 1% appreciation. It's going to change things significantly, and you can play with those numbers in the spreadsheet. So all of these pieces are really, really important. But for us, I think top line right now is cash flow. Mm-hmm. And then second is the return. I would rather have super conservative numbers, my return appear lower, right? I'm gonna almost bet every property you see that's already an investment property, when you're buying it, those numbers are gonna look amazing. But when you put it into the spreadsheet and you start getting yourself really wrapping around this thing and trying to figure out like, okay, what's this really gonna look like for me? You start to see what's real and maybe what isn't real. So right now, as you see it on the screen, this property as is not for us, right? Unless there's some crazy creative way that we could make it work.
Well, let's actually run through some numbers here, say them out loud, and then let's change the numbers to something that might work for us. So, for example, in this particular example, I know we got some listeners here not looking at anything; they're on their, they're in their car. In this particular example, we're looking at 123 Main Street, and we've talked about this purchase price of $200,000. We're going to go through line by line here, and we've got our land transfer tax calculator saying we're budgeting $2,500 for land transfer tax. We're going to spend about $750 for an inspection before we buy this property. We've got budgeted a little bit of pre-rent holding costs. We want to make sure that if there's no tenants in there, we're budgeting a little bit of that. We got $1,200. We're going to estimate about 1% of the purchase price of closing costs. So we're throwing $2,000 in there. We, in this particular example, we're saying, you know what, we're going to put about $5,000 into renovations. You might say, you know what, I'm just going to buy as is and not make any improvements. But in this example, we're looking at about $5,000 in renovations. That gives us a total project cost of about $211,450. And then that allows us to have a down payment, or we're going to put a down payment of 20% down. So that's $40,000, which basically says our mortgage is $160,000, and we're going to we're also going to calculate our total cash investment, right? Like, we're going to put the down payment down, we're going to put in the renovation, we're going to put in some of these other numbers, and it's going to come out to be about $51,450. So this number is important, this cash investment, for later on, thinking about our return on investment. The purchase price was $200,000, but we're only putting in $51,450 of our own cash, our own money. So that's an important number to look at there moving forward. So that we move into the financing section, we're going to be looking at our 6% rate from the bank. You know, we're going to calculate, and we're going to go and use a calculator. Our spreadsheet builds in your mortgage calculator that your bank actually uses. So we're going to spit out that we have a monthly mortgage payment of, in this case, Kyle, I'm just going to pause here because you're changing things.
There you go. I'm just playing around so people can see it all kind of adjusts. So we're back to 6%,
So
25-year AM.
Yep. And then, so we've got a monthly mortgage of about of $1,023.69. So that's important. Then we have our gross income. This is our rent. So this is our manually imported number. We have to go and figure this out. We talked about that already. So in this example, we had talked about putting $1,500. So maybe that's the rent that's stated on the listing. And then we're going to use that. We're going to go, hey, that's our income. That's all we're going to get for our cash flow. We're going to compare all of our operating expenses and our mortgage against that number right there. So our operating expenses, property tax, we need to budget for that. We've got, in this case, $166.67 a month. We're going to budget property insurance, about $100 a month. We talked about repairs and maintenance fund. We're budgeting 5% of the rent. So that comes out to be $75. Vacancy of the rent, 5%, $75. Cap expenditure, that's 10%. So this is like all the fixes we're budgeting for in the future. Think about a fund. We're putting this away. We got a plan for that. That's like our business. So if I budget 10%, that's $150 of my rent is going towards that. You can see that these are all adding up, and we only had a little bit of rent there to play with according to our mortgage value. We're also going to budget in our management fees, just like Kyle said before. We're accounting for that just in case we're switching partway through, or from self-managing to a management fee. We're always budgeting the management fee, so that's 7.5% of the rent is going to go to a management company. So we didn't put anything in this example for electricity, gas, because the renter is going to pay those, the tenant is going to pay those. That gives us a total operating expenses of $1,702.86. You can now see that our monthly cash flow is negative. We're in the hole right now if we go with this deal, because we're only going to bring in $1,500, and we've got $1,702.86. It's going to come out of our pocket every month. So we're in the hole $202.86. And then annually, that's in the hole $2,434.29. This is why Kyle said we had a negative cash-on-cash return of negative 4.73%, which is looking at comparing that to our total cash investment. So we're going to take our annual cash flow, divide that by our total cash investment, and go, this is what our annual rate of return would be with the amount we put in. Right now we have negative because we are losing money on this deal if we went forward. Thinking about after that, so that's a big one for us to say, hey, we're in or we're out. But after that, we've got those 3 silver bullets on mortgage pay down. If we went with this deal, after 1 year, we would have paid down $2,879.51 of the mortgage. So that adds a little bit to our equity of the home. We've got year one appreciation. We're budgeting, or we're counting, or we're just estimating 3% appreciation. Now, remember, we've talked about that in the past not being a hard and fast thing. We can play with those numbers. But if we put in 3%, that's about $6,000 for us. So that says, like next year, the homes are worth a little bit more. We've also paid down the mortgage a little bit. So that is that bonus, it feels like we've got a value add there. Our cash flow is negative, But so if we combine all three of those things up, we're looking at about $6,000 of value add to this if we went in the deal, assuming appreciation and assuming we've got that mortgage pay down. This is why we said that the year one return on average is 12%, because this money on our investment is a value add, even though we have negative cash flow. So the three silver bullets there help us decide what is most important, like Kyle said. So there's one full example walkthrough of the numbers. You can see that in the spreadsheet. If you want to go and grab that spreadsheet, again, that is at investedteacher.com/analyze. You can play around with that spreadsheet as well. Guys, let's adjust this and quickly run through one that we would say, you know what, this is worth exploring.
Yeah, and John, I think a couple of maybe points at this time as we ran through a scenario in which the cash flow is terrible, and at first blush you'd say I would never buy this property. But I think this is where the creativity of investing can get so interesting, and there are some ways that you could improve that cash flow. One that comes to mind, we've calculated a 20% down payment. So if you're someone, and this happens all the time right now in investing, where returns in other asset classes are uncertain, so someone may actually want to put down a larger down payment than 20%. Maybe it's 30%, 40%, whatever it might be. Up and up and up. That's going to certainly increase your return the larger the down payment. Of course, being able to put down 20% or 30%. That's that principle of leverage we've talked about in earlier episodes. You put a down payment down, you get to own 100% of something, but you've put down 20 or 30%. So
let's look at that there, Matt.
Yeah, go ahead, Kyle.
If I make it 30%, and let's be honest too, like Matt, you and I, we own at least since we came together, we own our investment properties inside of a corporation because we had plans to scale up. Again, if you're listening to this, you never bought an investment property, don't let corporation structure, all that stuff, slow you down. It's worth learning about, but get started. I have some property in my personal name from before we came together. Matt, you're the same. Corporation really only makes sense when you're going to scale significantly, or at least, and I'm not going to give you a number on number of doors. That's going to vary too. But for us now, we basically are having to put 30% down because we're in a corporation. So the banks are like, well, you're a corporation. There's less, or I guess there's more risk on the bank now because they're going, well, it's a corporation. You could walk away from that corporation and sort of, just leave it. Of course, we don't want to do that. We have way too much vested there. However, they oftentimes will say 30% minimum. So that's what you and I are dealing with. But someone who's outside of a corp can deal with 20% in typical cases. So putting 30% down isn't necessarily like an unrealistic thing. And all of a sudden you saw when I went from 20%, that's like $1,025, your mortgage payment. All of a sudden I go to 30% and now we're at $895. So now your mortgage payments jump down. All of a sudden, we're in a much better spot. You are now negatively cash flowing $75. Still not ideal for us, but there's all this other stuff to adjust. Like we put 10% for capital expenditure. This might be a property that we don't feel the need to have a capital expenditure monthly sort of, spot, right? It might be a very new property or a very well-kept property where we feel that the repairs and maintenance is all we need and that takes care of it. So what I would say is you don't want to adjust this just to make the numbers work, but you want to put the numbers that make sense for that particular deal in here to see where you are. And then are there things you can affect? And the next one I'm going to flip to you, Matt, is like, what about I'm going to put our capital expenditure back to 10%, but let's look at the rent here. What if the rent is low, but let's say the market rent is actually much higher than that for this particular property?
Yeah, that's another thing to look to as well. Are those current rents low, and what's the upside of those rents? So, you might, as you talked about earlier, you might get in on a property that you really like where, the tenants have been in place for a long, long time. So those rents are naturally lower because of that. But you see the long-term opportunity to hold on to this thing. Like our philosophy when we buy these properties is buy and hold long-term. We are not flippers. We're not looking to get in and out of these properties quickly. So we want to see that long-term time horizon. And then you also spoke about, and I've referred to this kind of debate previously about price versus cost. Like we are so drawn to the cheap prices all of us are. I think that's human nature, without enough regard for what that long-term cost is going to be. So if you are getting a property that is going to be turnkey, so you don't have a lot of capital investment to put in, versus a property that, it's going to be maybe cheap to buy, but you've got a ton of fixing to do, that's painful to take that money out of pocket. So this price versus cost debate is one you want to consider. What's your philosophy? Maybe you're somebody who's handy, you throw the hammer around, you like to get in there and get dirty. Personally, we have adjusted our philosophy over time, so we go more turnkey. Doesn't mean there aren't still things to be done, but we want turnkey properties, and we're willing to pay, a little bit more in order to be able to do that. And another creative idea here, Kyle, is maybe one we can talk about with our most recent purchase. That is called a vendor take-back mortgage. Now, not something that maybe an intro to investing will necessarily cover, but this is a case where the seller actually becomes the bank and holds the mortgage. So we were able to really creatively put together a deal on our 9-plex we just took possession of by paying a number that on paper was probably higher than we would have optimally liked, but the seller gave us very favorable terms. So the seller becomes the bank, meaning that in this case, we were able to negotiate for us interest-only payments at a very, very favorable interest rate, and not have to then go to our bank to be able to qualify and secure a mortgage. That was the first time we've been able to do a vendor take back, and the creativity around that is really what made that deal work.
For sure. Yeah, anything is possible, right? Like, it just depends on whether the property is important to take, right? And that particular property, Matt, was one of those properties that when we look at these operating expenses, like this capital expenditure, like up front in our mind, we're like, there is nothing to do at this property. Like, we see capital expenditures in the longer term. So we had this number a little lower than 10%, and the numbers still worked. And because of the vendor take back, we were able to actually significantly cash flow, which meant in this particular case, for that particular property, that we actually had less mortgage pay down. But the mortgage pay down, what we were losing in mortgage pay down, was now turning into cash flow, which is cash in your pocket now. So for us, we were looking at this deal as what an amazing opportunity to take down an amazing building. Every side or both sides, managed to make this thing work out. And ultimately, at the end of the day, we look at it as a business. It's not emotional. So we didn't go into this property saying, like, we got to have that property because, we don't want to lose it to someone else. We just thought this would be a really good ad for our portfolio. And I think you referenced it in a previous episode. It's probably our best property overall. Like, it's probably our best property because all of our previous were, more or less, the ugly ducklings, and we were going in for over time value add. And maybe that's you listening, or maybe you're going, I just want completely turnkey. Everything here in this spreadsheet is going to change. Different people are going to adjust different things in this spreadsheet depending on the property they're looking at and their own personal goals. So that down payment amount, as soon as we flip this down payment amount to 50%, all of a sudden now you're like, I own half the property on day one. Some people love that idea. Like I know my parents, for example, who are obviously older than I am, they look at that and they don't like the idea of having a mortgage. They don't care. Like, they're like, I don't care. I don't want a mortgage. I want to own it. And I don't like the idea of owing anyone money, even if the numbers, the return now goes down overall. But look at what happens down here. They're cash on cash now. They now have positive cash flow for them. The return on their deal now, the rate of return or the return on investment now goes down. But for someone who's super conservative, they might look at that and say, like, that's still an amazing, that's an amazing return on my investment. Plus I have a much lower obligation towards the bank. That is fantastic. And then if I go completely to no mortgage, which again, if you're out there and you don't need a mortgage, good on you. You're amazing. All of a sudden now, you know what? I'm going to go to, that was a full mortgage. Let me go 100% down payment. Because now our mortgage goes to zero. And all of a sudden, look at our cash on cash return is now like a pretty good return. This is money in your pocket, and your return on investment is still much higher than what you might anticipate from just random mutual funds, stock market, whatever, and you have no bank that you owe to. It's your property from day one.
I was just going to say, redo that part, but say the actual numbers. Like, we got all these people listening, but they can't see it. Right?
All right.
Like you
So
said.
let me-
You said if I change it to 100%, just start there.
Yeah, perfect. Okay, I'll go back to here. All right, so now let's change our down payment amount to 100%. This means that we now have no mortgage, right? I came in, I put down all the money, so you're going to have like $211,000, 450 are going towards purchasing this property, but now there's no bank. The interest rate doesn't matter. No amortization period, none of that. Now that is going to completely change our actual expenses, because guess what? Our mortgage payment's zero. So what was close to like $1,000 is now $1,000 that gets funneled towards you as the investor. When I go down and I look at those 3 silver bullets, my mortgage pay down is $0. That is what I'm losing because I'm now not leveraging anything. So I'm not using leverage here. So with anything, when you leverage something, there is some risk associated. So there might be someone who's like, I've got, this big, nest egg that I've been saving for retirement or whatever it might be. They might feel more comfortable just buying the property, knowing it's theirs, and there's never a bank that's going to come knocking. Their appreciation stays at 3%. They're still getting this like $6,000 that we're estimating. And again, your market might be very different. And I would recommend that if your market was at 12 or 20%, like it was over the past couple of years, do not use that number, because that is a top end number. We don't want that. We want something conservative. And the cash flow now turns into $9,800. So almost $10,000 of cash flow every single year on this particular property. There's some people who are like, wait a second, I've got mutual funds. I have $200,000 in mutual funds, and I am not getting $10,000 of equity or $10,000 of cash flow, as well as $6,000 of appreciation. So their investment's going up by like $15,850 on a property that 2 minutes ago we're like, we don't want that property, but somebody else might want that property, right? So they look at it, the rate of return, or the return on investment, I should say, would be around 7.5%. Their cash on cash in this particular case would be 4 and just over like 4 2/3%. So almost 5% cash on cash, money in your pocket. That might be, for some people, like that might be enough to supplement their retirement, right? Savings that they want. For other people who are like us, you're going, I want to throw a little bit of leverage in there so that I can save some of my money and buy another property and sort of, compound this a little bit faster. So once again, it all comes down to analyzing, and how we analyze this property. The result from us might be it's not for us. But for the next person, it might be, this is exactly what we're looking for, and this is where I want to go next. So the key is, know what you're looking for, go back to that fundamentals episode, and then once you know what you're looking for, start running and analyzing as many properties as possible so that you can figure out, like, what are you comfortable with and what are the variables that need to change based on this property in your market that you're shopping in.
Awesome stuff there, Kyle. I like that walkthrough. I like that you turned this one around. And it does feel like when I'm hearing those numbers, it sounds like that sounds great. When initially we looked at this and it didn't sound great. So does depend on what we are looking for our investment. And this tool, the spreadsheet that we're using in this example here, can be your getting started guide, right? This can remove this hurdle of how do I analyze a property so that I know if this is the right property for me or it's the wrong property for me. Oftentimes we use this to make sure that we rule things out, like, well, it doesn't hit these numbers. And what it means also is, like, the more properties you can analyze using this tool, and even though you're tossing them all away, eventually you're going to use this tool with a property and it's going to say, this is the one. This is the one I want to investigate a little bit further. The more properties you can analyze, the better you're going to get at it. This gives you a stepping stone to get down that pathway. So that hurdle of, like, how do I analyze? We wanted to address that here. Use this spreadsheet as your starting guide feel free to manipulate it. Feel free to change it. And if you have any questions about that, reach out to us. Reach out to us by email. Head on over to investedteacher.com, get on the email list, hit reply on any of the emails we're sending you so that you can ask questions about this. We're here for your guidance. Like, we want to be your guide along this path as well. So that's a big takeaway for me, guys. It is to make sure that a stepping stone here is to use this to help analyze properties. Do it as frequently as you can. Get yourself on a listing, like Matt mentioned in the last episode. Have those properties come to you, run them through the analyzer, put them in, and then see if they work. You want to analyze as many as possible. Also, flip it to a friend. Flip it to somebody. Go, hey, you analyze this property. Let's discuss this. Did you come up with the same conclusion that I did? Those are some big steps for you guys to take next.
Yeah, I think my big takeaway from this episode, John, is just that the numbers don't have to be intimidating. If you're not somebody who feels like they're strong with this stuff, all you really need to know is how the numbers you need to ask for, which we've reviewed in this episode, and then how to input them into the spreadsheet, and the spreadsheet will work the magic for you. So don't be intimidated by that. I was at first, and my level of comfort has grown so much because we've got this great tool that we can use for you.
I love it. I love it. And fellas, my big takeaway, and again, I always like thinking back to like where my blind spots were, and there were many, and there will always be many blind spots when you look back on the past. I wish way back then I wasn't looking for the perfect property. I was more open to this idea that there are different scenarios that might make sense for different properties. So I wish I better understood who I was as an investor. I was sort of looking for like the best property out there, which is really hard because even though I'm now happy about the investments I made back then, the reality is they weren't the best properties that were out there, right? I mean, they were the best that I knew about. But it took me a really long time to get there. So when you understand who you are as an investor and what you're looking to achieve, that'll help you get there. And I'm thinking, some people say like never buy if it's cash flow negative. I don't think that's necessarily true. Never buy if it's cash flow negative if you're speculating on the market bouncing, tremendously. But if you're the type of person, you're like, hey, I've got a really good salary and paying $75 towards this property that I feel really confident in. And that's something you're willing and able to do over the long term, as well as able to cover any of those unexpected expenses, might be the right move for you. So really, there is no hard, fast rule, but just know what you're signing up for. And the one thing I think that we all want everyone to hear is that this is a long game. You're not going to hear on this podcast, you're not going to hear about get rich quick. You're not going to hear, Matt, you said it already. It's like we've done flips. We have never felt good about them. We've luckily never like lost our shirt on any, but we felt like it wasn't worth the effort for us. That doesn't mean flipping is bad. It just means that's not what we're necessarily going to talk about here on this show. We're going to talk about how can you take what you're doing in your everyday job and how can you get into this market so that over the long term, you're going to set yourself up to feel good. And when you look back, like I look back a decade ago when I started getting into this and I go, I feel good about that. It wasn't the best. I could have did things different, but I feel good about it. We want you feeling good about it too. And hopefully this sheet and these episodes are going to help you along with that.
Awesome stuff there, guys. And just as a reminder, you want that sheet, head on over to investedteacher.com/analyze. And if this is your first listen, right? If this is the first episode that you've jumped into us with, please hit subscribe, hit follow, and you'll get notified of all the episodes that go out. We release these on Wednesday mornings every single week, and this one being episode 11. So also, please do us a favor, hit the do us a favor, hit the rating review. Leave us a review on there. That helps get the show to as many new investors as possible. And don't forget, we're on all social media platforms. So if you're looking at your analyzer tool and your spreadsheet and you got a question, jump on over at Invested Teacher on any social media. So that Twitter, Facebook, ask a question. Reach out to us. We'd be glad to get back to you as soon as we can.
We've posted all the links, resources, and transcripts from this episode over on our website. That's investedteacher.com/episode 11. That's incredibly important for this one because we want you to grab that analyzer tool. That's at investedteacher.com/episode 11.
Amazing, my friends. A couple other links that'll be over there for you if you haven't done it yet. We've got a giveaway going on, and really, you can win all kinds of great prizes, some gift cards. You can buy some of our favorite books on investing in real estate and other avenues over at investedteacher.com/giveaway. You'll notice as soon as you put your name in there, basically what's going to happen is they're going to say, listen, we'll give you more entries if you go hit that subscribe button, if you go and leave us a rating and review, and a few other ideas there. So definitely go over and do that. And remember, for those who are listening to this and going like, I want to get started right away, I want to learn as much as I possibly can so that we're not doing what Kyle did, which was wait around for 2 years every single night, researching until bedtime, having your wife look at you like, what the heck are you doing? If you want to get into it now, we have some upcoming deals that we're excited about. So we're looking for joint venture opportunities, or those who are interested in engaging in a joint venture. We're building that list over at investedteacher.com/JV. Once again, you can just add your name to that list so we can reach out to you over at investedteacher.com/JV. All right, my invested students, class dismissed.
Just as a reminder, the content in this episode is only for informational purposes. You should not construe any such information or any material as legal, tax, investment, financial, or other advice.